Welcome to episode 232 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. And mate, Nick, you always find a way to get Donald Trump mentioned. So I'm going to throw to you. What have you got for us today?
I am going to mention Donald Trump, but I'm just going to talk about the best way to make money in the stock market, and it's to do absolutely nothing.
Great.
Almost.
Awesome. Great app. Thanks for
Almost.
listening.
Makes sense?
I think almost was a pivotal word there.
Almost. So,
Almost. Tell us more.
well, let's talk about Donald Trump. And I think that since he's been in office, and he hasn't been in office long, and the US share market has dropped 19%. So, what we're seeing at the moment in the share market, and we've seen always, at the moment it's Donald Trump. Prior to that, it was geographical or political issues with Ukraine and Russia. Then you've got COVID. Then you've got what was that thing around, Marty, when you were younger? What was it called?
The Great Depression.
That's right, the Great Depression. So there's always volatility in stock markets, and it's definitely relevant at the moment because Donald Trump is causing a lot of volatility with his gun-ho-ness and his silly tweets. So what I wanted to discuss today was a concept called dollar cost averaging. It's something that we talk about every day in our office as financial planners. And it is a proven strategy over the long term that, serious investors, Marty's favorite man, Warren Buffett, Charlie Munger, these guys are definitely promoters of dollar cost averaging. So I want to explain what that is. And then if we've got time, talk about rebalancing to take it to another level. But before I rip in, dollar cost averaging, Marty, Jace?
I'll leave it to
Any
Marty.
idea?
Marty loves this stuff.
No,
Throw to Marty.
I think it's just sensible because whether it's managed fund or EFT on the major indices, you can never time the market one way or the other. So I think it all comes down to the method of what you're doing, and dollar cost averaging is just putting money in the market, and over time, it's going to work for you and compound. So,
Well, the actual question was, do you know what it is? But not only do you know what it is, but you've actually understand the power of it. So I should have known not to go to you because you'd be all over this stuff.
Yeah.
But yeah, mate, you're spot on. And dollar cost averaging is spreading your money into the market over the long term. So obviously, as investors, we all want to buy when the market dips. There's a couple of things that we need to do to make sure that we buy when the market dips. Number two, we need to be able to predict what it's going to do, or not so much dips, but we want to buy when the market bottoms. So that requires us predicting the future, basically, which no one can really do. If they do it, it's a fluke. It also relies on us having courage to buy the market when we think it's at its absolute lowest level. Because what I can tell you is, as much as most people think they will buy when the market is down low, because that makes sense, not many people have the courage to do it because they will always think that it's got a little bit more to go and they won't want to risk their money when they see the market is going down. So buying when the market is down or at its lowest absolutely makes sense, but it's very difficult to do it. So dollar cost averaging is a really good strategy to ensure that you don't eliminate risk, but you definitely spread your risk. So to put it into an example, if someone came to our business and they said, Nick, we have $200 to invest and we would like to put that in the Australian share market, $200,000 to invest, and we'd like to put that in the Australian share market. And it's May 2025. We wouldn't put all of that money into the Australian share market straight away. What we would do is we would suggest that they spread the investment into the market, depending on their risk profile and depending on how much money that $200,000 made up of their overall asset base. We would say spread that money out. So hypothetically, you might do, we're talking $200,000. You might spread that out over 6 months at a contribution to the market of around $30,000. So that means every month you're putting in 32,000, whatever that number is, to get you to 200,000 over 6 months. Now, what it means, if we have an event such as COVID, where the market drops by 30% in a 1 month period, you haven't exposed your entire $200,000 to that 30% market drop. if you had to put 30,000 in, you've only put 30,000 in, it's dropped by 30%. So your 30's gone down to 20 instead of your 200 going down to 140. I think that is. Is that right?
Spot on.
Yep. So dollar cost averaging works in that way. It also works in the way that if you are going to invest in a stock market, you should continue to invest at a certain amount on a regular basis, whether that's weekly, monthly, annually, even biannually, whatever makes sense. But if you put money into CBA today and then you continue to put money into CBA, as in the Commonwealth Bank stocks, what you're doing is you're buying them at different periods. So some months you're going to buy it, it's going to be higher. Other months you're going to buy it and it's going to be less. But you are averaging out your purchase price of the Commonwealth Bank, knowing that they're going to go up and down. And again, you're eliminating your risk and you're not exposing everything you've got to one particular value on a particular day. So far with me? Making sense? Yep.
Big time.
So this is why superannuation is so powerful, because what happens with super is the decision generally to invest is taken out of our hands. Our employer pays our 12% super into our superannuation fund, and that money is automatically invested every month or every fortnight, depending on when you get paid and when your money goes into the market. So you are dollar cost averaging in your superannuation, generally, whether you like it or not, which is why superannuation does so well, because it's on a particular strategy. We can't muck around with it. We can't grab the money. We can't decide, oh, now's a good time to go in, or now's not a good time to go in, oh, I should sell now and move to cash. None of that stuff happens. We just stay invested and we keep on getting invested under the new market price every time our money goes in, which is why super performs really well.
Super's a great example. I think, whether it's weekly, fortnightly, monthly, or quarterly. Quarterly would be the short or the longest period of time it should be waiting for your money to go into super each quarter based on the rules at the moment. But think about from July 26 onwards when it's payday super. So if you're paid weekly, you're going to have super hitting your super fund every week to be invested. So that dollar cost averaging is going to be quite incredible to see when we get to that stage. It's a really good example. Yep.
Yeah. And look, we do people's super projections when they're younger and show them what it's going to be. And, when they're 60, 65, and it's quite difficult. This is to be completely transparent. It's difficult to convince people that that's going to be their super balance, particularly if you've got a young couple, both in professional jobs earning 6 figures plus in their late 20s, and you can show them their combined super is going to be, somewhere between 1.5 to 2 million. They almost struggle to grasp that concept until you show them. And just to put into another example, if you're spending $10,000, on the 23rd of May and the CBA cost $100, then you're going to be able to get a certain amount of shares. If you put $1,000 into the market on the 23rd of June and the CBA only costs $90, and you're going to buy more CBA stocks. So a couple of things to think about, because people out there will be thinking about this. Well, what if the dollar cost averaging costs me money? As in, I dollar cost average and the market kept going up. Well, that is a definite possibility. If you're in a market where it goes up and up and up, and you do prolong the investment into the market, it's going to end up costing you more. That's the reality that people need to face. However, for a lot of people, and not a lot of people, 99% of the population, there's study around the behavioural bias that the pain of a loss is far more, or felt far more, than the pleasure of a gain. So, we see this in the financial planning business all the time. People kind of almost brush off the returns and the gains. Obviously, when things are going up, you don't hear from people. And then when you have your annual review, you talk to them, they go, oh, that's good, it's gone up. The minute it goes down, they're on the phone. So the behavioural bias is definitely that the losses do concern us more, because that's the money we've earned and now it's going backwards, versus I had this amount of money, now I've just got a little bit more. So for us in our wealth business, the trade-off of possibly getting a bigger gain, that is what's way better, not getting that gain than putting all the money in and then facing a loss, because we know what kind of ramifications that has for people's stress levels and overall mental well-being.
I was doing some numbers just on the importance of managed funds, and even people are investing outside of that in indices like the S&P 500. And I was just messing around with saying, what happens if you only invested when the stock market went down on the 50-day moving average or the 200-day moving average, just to see what impact it was? And it was really interesting because when people were investing like that, their returns were actually only around about 7 or 8% because of the fact that they weren't in it for the long term and making fewer deposits, right? So the dollar cost averaging, the consistency. So when the stock market goes down 5%, if you're investing there, it's actually closer to dollar cost averaging. So, but when you look at that as a whole, the S&P 500, I think returns around 13% or something like that. But when you look at it as a whole, what Nick's saying is really important. It's the consistency of input into the market that's really good. And people sometimes want to do that with individual stocks, but the danger of that is you might dollar cost average into oblivion, down and further down and further down if it's a bit specky, but on an indice or a managed fund, you've got that big spread, a basket of stocks that come in and out and is managed by someone. So you've got a lot of protection in that dollar cost averaging happening across the board. So it's amazing that you do get that massive benefit of the consistency of the behavior, of the input of funds into the market, so you can ride the highs and ride the market in general. So yeah, it was an interesting exercise actually.
Yeah, it's a great point. People sitting on cash because they're waiting for that particular day, and they've missed all those gains in the meantime. And actually, it's a really good point that you brought forward around not so much investing in a particular stock, or we're talking about being invested in markets, having some money across the ASX, the S&P, bonds, even if you're in more of a defensive asset allocation. So, and the other thing that I wanted to mention, and just to take it to another level, and this is what a managed fund will do, and I don't want to go into advice here, but and ETFs will do this as well, but talking about rebalancing as well. Because a lot of people don't think about that, and you can even do this yourself if you really want to. I'd probably recommend you didn't, because it can be difficult. But if we're talking about rebalancing, it's understanding what your particular asset profile should look like. So I'll just give and I've probably spoken this before, but I think it's worth mentioning again. I'll give a really basic example. Marty or Jace, 50% of your money. You decided that for the long term you should be dollar cost averaging into a investment fund that was 50% invested in US stocks and 50% invested in Australian stocks. Now, obviously you're dollar cost averaging, so you can continue to put more money into those stocks. Now, what you'll find, and what you would have found traditionally, is US stocks have done far better from a growth point of view than Australian stocks have been. So if you decided I want my money split 50-50, at some stage what's going to happen is your money is not going to be split 50-50 because the US stock market has outperformed. So let's say you had 100 grand in there in 2025. Fast forward to 2026, you've got 120,000 in there. But your US stocks have outperformed your Australian stocks. So you've now got $70,000 worth of US stocks and $50,000 worth of Australian stocks. So your US stocks have gone up, your Australian stocks haven't moved, but your split is now, work that out, Jace, you're the accountant.
58.3%.
So your money, just by just through the result from market conditions, you've now got 58% of your money in US stocks, and only 42%, I know that one, Jace, put the calc away, only 42% of your money in Australian stocks. So that's not ideally what you wanted. You wanted 50-50. So what a rebalance will do is you will sell the US stocks to get them back down to 50%. So basically you're taking a little bit of profit off the table from the USA stocks, and you're reinvesting that money that you made back into Australian stocks. So the idea is when the US market is peaking or going up, you're taking a little bit off the table and you're putting it back into the Australian market, which is cheaper than it was 12 months ago. Now, assuming you've got an ETF or a managed fund and you've got an entire market and you're not just making a decision on one stock, you are historically guaranteed, almost guaranteed, that those Australian stocks are going to get back to where they were because you've got a whole market. You haven't chosen one stock. So if you want to go that extra level, rebalancing is taking little wins, putting it back into the stuff that was cheaper, and you continue to do that. Fast forward 12 years or 10 years, there might be a situation where the Australian stocks have done more. So you've taken a little bit of money off the table there and put it back into the US. That's what gets you the ultimate performance. And these days, that's pretty automatic with ETFs. If you've got a mixed ETF with different allocations, they will rebalance. A managed fund, if you're with a financial planner, most people's superannuation will be rebalancing all the time. This is stuff that happens in the background, but that's how you get the ultimate result from dollar cost averaging as well.
Yeah, I like that a lot. I mean, the accountant in me says, you've got to be wary if you're doing it yourself, not to trigger capital gains tax in the wrong way. If you're falling a little bit short and you've held it for less than 12 months and you think, yep, it's time to rebalance, and all of a sudden you're missing out on your CGT discounts. So obviously that's something, if you work with an advisor, they're going to be talking to you about these things. If you do opt for the self-service mentality, you're going to go away and,
it's a great point, Jay. So like in regards to like selling down to balance as opposed to it automatically happening in the managed fund or the ETF, it's no doubt some tax savings in that.
Well, and it's definitely something that as accountants we have to explain to our clients when they come in with their ETFs and their managed funds and they haven't necessarily seen cash, but we tell them that it impacted their tax bill and they sit there a little bit confused. Like, well, no, I didn't touch my managed fund. All the money's still invested. Nothing's changed. But what they're not seeing is that when things are kind of rebalancing or moving around within the ETF, even in the change in investments as things come and go off, the ASX 200 or what, depending on what you're following, it'll cause movements in what shares you own or what stocks you've got, and then also the rebalancing. So one to watch when you get accountants are always going to be sitting there at the end of the year asking for your tax statement from your managed fund. This is usually the movements that are occurring, causing, but also would not say to let the tax outcome stop you from implementing this strategy, because over the long term, any good strategy performed over a long term is going to help you achieve those goals that you're after, and especially, dollar cost averaging. I mean, I'd much rather see, especially with business owners that are accumulating wealth or individuals that have a regular set pay, if you can carve out X amount per week or X amount per month to continue to be invested, that strategy over a long period of time is going to be life-changing, and it's an absolute game changer. It's the ones that, get emotional, try and determine the market's timing, and, they kind of overthink it and they sit on the cash, the stuff that Nick was talking about earlier. And it's often self-sabotaging when the strategy is to chase returns and to sell things and move based on bad news, rather than just a simple strategy of regular investments into something that is set and forget. That's what we want to see.
Well, Buffett and Munger, approach it that way. I find it fascinating that they just say, just put 10% in dollar cost average into the US market, and in the end the US market will win at the end of the day. But I find that what's interesting about that is that's what super does. You know what I mean? That super's that enforced investment that is the best thing that can happen to any individual because they can't get to it. And I just think if people aren't self-disciplined to do that themselves, what a great thing that we have super. But why not enhance the strategy and look to add to that base strategy through a financial planner and get some managed funds on board?
So there's a few key takeaways there. I think number one is you need to understand, if you're going to look at rebalancing and whatnot, you need to understand what your asset allocation should like. It needs to be appropriate. You need to understand fees associated with going in and out of funds. To Jason's point, tax associated. So, I'm a strong believer in, find a product that will do it for you, such as an ETF, or go see a professional and look at a managed fund. And I think the other key takeaway is it just builds a habit and it takes away the guessing game. The only habit you need to implement is transferring $100 a week or a certain amount a month, whatever it is, to an account, and the rest is taken care of for you. And it's pretty easy to look at an ETF online and understand how it's performed. With regulation now, all the historic performance numbers are there. You can see how it's invested. You can see the fees. You can see all this stuff. So information is very accessible now. You just need to create the habit to put the money somewhere, and then let the experts do it. And these days, with an index-based ETF, it's you're pretty safe in the way that not that you're guaranteed returns by any means, but you're pretty safe that they are doing the right thing as far as trying to get you the best return possible with a great diversified asset allocation. So a couple of key things there before people, try and buy CBA on the dip every month, because I did mention CBA a couple of times, but I just thought they were a good example.
Well, I think what you said, Nick, as well, is around, and if you don't have the nous to create that habit and do it yourself manually, set it up automatically. Like set up the rule in your bank account, do the BPay or the transfer, $100 a week, $1,000 a month, whatever it is. Once it's set up in your banking and sent off to the managed fund or whatever platform you're using, just pretend it's not there anymore. Let it go, and then look at it in a few years' time or when you do your review with your advisor. For people that do use particular platforms, just keep in mind brokerage fees. If you are trying to manage it yourself and you're doing little smaller chunks, every time you invest or move something around, if you're getting charged a platform fee or a brokerage fee, this could be chewing into what might not seem like a lot at a time, but remember that compound effect is that every time you make a move or buy or sell something, it could be chewing into your returns over that long period.
And foreign exchange costs as well if you're sending money overseas as opposed to buying in an Australian ETF. So things like that are important.
Yep. And I'd say the other ones, wouldn't be the accountant in me wouldn't be here if I wasn't thinking from a tax and savings point of view. But even if it's not something personally that you want to have in your own name and you're worried about the tax implications, you could supercharge your super by doing salary sacrifice. So that'll then have the same effect. Do an extra $100 a week or $200 a week into super. That's going to then have the dollar cost averaging kind of extra humming along in your super fund in a great tax environment where those earnings are 15 cents to the dollar. You might be on 45 cents to the dollar personally. So keep that in mind. And if you're sitting down going, shit, this is a great strategy. We've got, Nick talked about the 200,000 spread over a couple of months getting into the market. Again, before you go and do these things, if you're working with an advisor, accountant, financial advisor, there's also things you might consider like a family trust. And that way the family trust might be about growing wealth for the generations of your family. And then that way when there's tax distributions, you, the individual, might not be the only one that has to then pay the tax on that wealth. You might be spreading that wealth across your family. So a family trust could be a great strategy for this as well.
Yeah, and professional advice is so important here yet again. I know we harp on about it, but even like I was doing some research on people that just generally invest in the market, day traders and things like that, and they reckon within 90 days, day traders burn pretty much 90% of their capital because there's no methodology behind it. So it seems easy on the surface to hit the next big winner, but no different to sports bet, right? So it's like get the right advice, get the right methodology, get in, minimize your risks at all costs, and you'll have a big upside, in time. Patience.
That's it. Slow and steady wins the race.
Slow and steady wins the race. Thank you for joining us on another episode of The Numbers Game. Make sure you like, share, subscribe, tell a friend about us, jump onto YouTube and watch a video if you haven't before. And give some comments into all those sections. Follow on Instagram. And as always, Jace, Nick and Marty are available on LinkedIn if you want to connect with us and, send us a message, ask us a question. And the email address, hello@thenumbersgamepodcast.com.au. Plenty of ways to get in touch. Until next time.
Compound interest is the 8th wonder of the world. I'm not sure what the other 7 are. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.